Good afternoon. Peter Klein, Chief Investment Officer, co-founder, ALINE Wealth, with you this 7th of January, 2026. Just giving a couple of slides here to talk about the current market and economic conditions. This is what we do every month. So hello and Happy New Year to everybody. Hope everybody has had a wonderful holiday season. And again, to 2026. And so far, it has been a very interesting couple of days. We're only halfway in the first week, and it's already been super interesting with all that's happening, both geopolitically as well as domestically. And markets, of course, have really been very intriguing. I want to talk about what's going on and give you a sense of how we're seeing both risks and opportunities. That's what we do at ALINE Wealth. We have a dual mandate. We are fiduciaries, and we are focused on not only understanding the capital markets and how to provide our clients with the best optimized return for their capital investment, but in the same token, we are, because we're fiduciaries, we care, and we are deep financial and estate planning centric, and we're always watching out for the what if. So in our dual mission of both making money for our clients, but also protecting for their long-term legacy. That's how you think of ALINE. Okay, onto the slide deck we go. Okay. So let us go to this slide, and here you will see, there it is. The question, of course, is AI, is the juice worth the squeeze? Now, what we mean by that is everything has been AI-centric in the last 12 months, maybe even 18 months, if you really want to look at it. In fact, they say in 2025, if you strip out the AI exposure to the market as well as to the economy, it would have been a flat market and a flat GDP. That's how much money is going into the sector. That's how much growth is happening from the stocks that are expecting huge continued demand and productivity gains from the products, from the adoption of AI. But this slide from the Financial Times takes a different look at it. And it's saying in the short term, and then, of course, in the longer term, how much increase in productivity what are the estimates for that productivity gain? And as you could see, it's not too much. I mean, if you look at it over the longer term, McKinsey has it, an upper estimate of 3.4, Goldman 1.5, McKinley's lower estimate is probably sub half. And if you look at the historical productivity gains from different eras, you could see that really is not super extraordinary. That's my point. As a longtime investor and someone who's seen many of markets and money cycles, it seems to me like a lot of the excitement has been pulled forward, right? And that's important, because at the end of the day, we're buying shares of companies today at these today prices. And that price matters. That entry into that investment matters. And if you're paying a high price, a high multiple, right, of earnings, a high multiple of cash flow, a high multiple of book value, et cetera, if all of these multiples that you're paying for when you get in, that is going to have an impact going down the road when you're looking to how that investment is done. But this is the nature of stock investing, right? The nature of stock investing is always, in the short term, it's like a voting machine where this is from and others, Graham and Dodd, and he said, hey, in the short term, stock investing is like a weighing machine. I mean, like a voting machine where everybody's vote makes a difference. So think about that. Everyone's investing makes a difference. More buying, stocks go up. But over time, the stock market's like a weighing machine where the empirical evidence, ergo the metrics that we spoke about, cash flow, earnings, etc., that makes a difference. So I think what's happening here is a bit of, perhaps, dare I say, irrational exuberance. Well, maybe it's not irrational, maybe it's just hopeful exuberance. But we don't know what the end game is going to be on AI and how much productivity it's going to put forth, and will that productivity keep inflation at bay, et cetera, et cetera. Hey, we all want a silver bullet, but they are rare. I also suggest that you look at a video we did a couple days ago on AI and data centers, an explainer video. It should be in your inboxes in the next couple of days. Okay, next slide. The CapEx spend. All of these companies are spending so much money on AI and the infrastructure thereof. Again, the hope of is that this capital investment is going to continue to yield returns and productivity enhancements and more growth. But as I said, that entry point, that velvet rope to get into the game, into the show, is an expensive ticket. You know, you just don't get in easily. You're paying up for this, and we are paying seriously up for this. Look at the first chart. That is the cyclically adjusted PE ratio, the CAPE, made famous by Dr. Robert Shiller of Yale University, Nobel Prize winner for this research of adjusting the earnings. Remember, PE, price to earnings. You adjust those earnings over a 10-year period, smoothing out recessions and, of course, growth periods, and getting a more sort of a smoother figure for that earnings number to that end, and you're still seeing we're at the highest we've ever been, except for the dot-com in 2000. So that would give any investor a pause. That would give any fiduciary who's investing other people's money with a dual mandate to make and protect pause, because things aren't cheap. The idea is to find those investments that are still not yet overcooked on valuation, that still have potentially some opportunity adjacent to AI, part of the picks and shovels trade that support the AI or data center infrastructure. I do like that area a lot. That infrastructure, again, the video, the explainer goes into that a bit more. The second chart is also one of Buffett's favorites. It's a sort of a PE ratio on the entire economy. You're looking at, this is the reverse of the PE. This is just looking at, U.S. market cap as a percentage of GDP, all-time high, all-time high. So everyone's in the pool, household ownership of stocks through the roof. Everyone's in the game. You have to sort of say, at least I do, let's sort of take a look at this and let's see where we're positioned. And let's make sure we have a very soft and big chair to sit on when the music stops. That's our goal, making sure our clients have that margin of safety, that cushion, that chair. So when the music stops, we're going to be okay. Our financial plans are going to be okay. Our legacy for our clients are going to be okay. Now, you see, again, here's that valuation metric, folks. I mean, this is serious stuff. I put this in yet last night because I thought it was so compelling from our friends at GMO. Okay, yes, GMO, a very value-oriented firm. You could even call Jeremy Grantham, he calls himself the Perma Bear, and he has a new book out to that title. So I get it, but facts are facts. This is not his opinion. This is a fact, right? And what we're looking at is an inordinate, I would even say off the charts crazy number of percentage of companies in the S&P that are trading at more than 10 times sales, not earnings, sales. That's not sustainable. Period. End. It's not sustainable. One has to be careful when the market, 30% of the market is trading at 10x sales. If you look at the equally weighted S&P, remember the S&P 500, the one we all look at every day, is cap weighted. There's also a equally weighted S&P with the other, where every stock in the 500 stocks are equally weighted, much more broader index, right? Because remember, in the S&P, the cap weighted S&P, 10 stocks are almost 40% of the index, so very much skewed to those 10 stocks. So even in the equally weighted, we're very high on this 10x price to sales ratio. It has me concerned, because this is not earnings, this is sales. And a lot has to happen for sales to come down to earnings, to come down to, to actual distributions to companies, dividends, etc. That has a lot of in between there. And if you're trading at 10x, there's not a lot of room. Color me cautious. What is value, and why do we look at valuations? Why are we so valuation centric? here at ALINE Wealth. And a lot of it has to do with the evidence, the empirical, definitive, factual evidence that says without unimpeachable evidence that says when you pay up for an investment today, ergo higher PE, higher price to sales, etc. When you pay up for an investment today, your longer term returns are muted. Okay. Short term, it's all noise. Anything can happen, momentum, things continue, whatever. That's the short term. No one really has a way of knowing that, right? But over the longer term, which is where we live, frankly, and we do financial planning, estate planning, legacy planning, this is what we look at. It has a major, substantial impact to the overall portfolio. So, and that's important, right? So that's why we look at valuations so importantly. Okay, this is a slide that talks about the cap weighted the index versus the earnings. So what you really want to have is a tight correlation. They call that R squared, for the math geeks in the room, right? We want a tight correlation between earnings and market cap growth, right? They're both going the same direction. Sure, as per the previous comment about how in the short term, investors are, more like a voting machine. I could see why you would have the market cap above the earnings, but it should be tighter. And you could see from this chart that they have most of the time are tighter, except for when you have these sort of, dare I say, bubbly periods like in 2000 and then most recently in the last couple of years. So look at that and let's make sure the earnings can catch up to the market cap. I'll leave you with Buffett and cash and how his got about 28%, maybe a bit more now in cash, and I think he knows what he's doing, and his team knows what they're doing, and I think that they see opportunities. Perhaps elsewhere besides the typical S&P stocks, and I think that there is a reason to have a balanced approach. At ALINE Wealth, we are more focused on that balance than perhaps others are, and we like using cash as a fixed income proxy because of the fact that we still think that inflationary pressures are still in the economy. And this wealth effect, by the way, guys, the substantial wealth effect over the last 3 years. Everybody's in the market. Markets are going up 3 years in a row. That has implications to inflation because there's more money, more sloshing around, more activity, more spending, right? And all of this, I think, leads us to the thinking that there very well may be more inflationary pressures down the road, which leads us to believe that one should have more cash than fixed income exposure. So that's how we think of that. And then finally, we have opportunities because we're always looking for opportunities, and we look for those where others may be sellers and where it's washed out and where there may be a substantial margin of safety with extraordinarily valuable companies that are being thrown out with the bathwater, as they say. And healthcare is certainly one such industry where we are finding special situations and opportunities. I would say there are others as well. Energy is another one that we've been looking at and focused on and invested in. We like commodities, as you know. We've been early advocates of that trade for a couple of years now. It was humongous last year. So that worked out really well. So we're looking at those points, but remember, we're buying them with a margin of safety, folks. We're protecting and we're growing. We're not just throwing caution to the wind and hoping things work out. Hope's not a strategy. That's not what fiduciaries do. Fiduciaries look for the empirical evidence to support their case. Okay, so I think that is it. You have our contact information. Here's some disclosures. I'll stop to share. I'll say goodnight. Thank you for your time and your consideration for ALINE Wealth. It's very important to us, and we're very appreciative of the vote of confidence. Have a great month. Stay warm, and we'll talk to you next month. Thanks again.